Robert Delgado stood in his kitchen in Tulsa, Oklahoma on a gray Tuesday morning in March of 2026, holding a coffee mug that said, "World's Okayest Fisherman," a gift from his son-in-law 3 Christmases ago. The radio was playing low in the background, some AM station running through the weather, and the smell of burnt toast still hung in the air because Robert always set the toaster too high and never remembered to fix it. He walked to his mailbox the way he did every morning, past the flag he flew every day since retiring from the county road department, and pulled out a thin white envelope with a return address he didn't recognize at first. He opened it, standing right there on the driveway. 2 days later, $3,140 disappeared from his checking account. Gone. No phone call. No knock on the door. Just gone, the same account he used to pay his mortgage, his heart medication copay, and the light bill. This is not a scare story. This is happening to real retirees in real kitchens across this country right now, today, while you're watching this. And the worst part, the part that should make your blood run cold, is that what happened to Robert was completely legal. Here is the sentence you need to burn into your memory. The IRS has the legal authority to reach directly into your bank account and take your money without ever going to court, without a judge, without a jury, and it is allowed to do this under a set of rules most Americans have never been told exist. Rules written by the same government that is now enforcing them against the people least equipped to fight back. Over the next 30 minutes, I'm going to walk you through exactly what triggers this, exactly what the rules require the IRS to do before they can touch your account, and exactly how you protect yourself so what happened to Robert never happens to you. Let's start with what actually has to happen before the IRS can legally take $1 out of your bank account, because this is where most people get blindsided. It is not instant. It is not random. It is a sequence, and if you understand the sequence, you can stop it cold at almost any point along the way. Step 1 is what the IRS calls a notice and demand for payment. This is the bill. This is the first letter that says you owe money. Most people, like Robert, either don't open it right away or open it and set it aside because it looks like every other piece of junk mail that comes through a mail slot. That is mistake number 1, and it is the mistake that starts the clock. If you don't pay and you don't respond, the IRS moves to step 2, which is a final notice of intent to levy, combined with something called a notice of your right to a hearing, sent under Internal Revenue Code section 6330. This is the document that matters most in this entire process, and I want you to hear this clearly. By law, the IRS must send this notice at least 30 days before they can legally levy your bank account. 30 days. Not a suggestion. A hard legal requirement. If they skip this step, if they levy before that 30-day window closes, the levy itself can be challenged and reversed. Now, let's put real numbers on this the way I'd explain it to you across a kitchen table, using a case built off what happened to Robert. Say, Robert owed the IRS $11,200 in back taxes from an underreported pension distribution 2 years earlier. The IRS sent the notice and demand. Robert didn't respond within the standard window. The balance grew because unpaid tax debt accrues interest, and a failure to pay penalty of up to 25% of the original amount under Section 6651, so that $11,200 over about 18 months of silence climbed to roughly $13,900. Then came the final notice of intent to levy. Robert had 30 days to request what's called a collection due process hearing using Form 12153. This form is free. It costs nothing to file. And filing it does something enormously powerful. It legally pauses the levy while the hearing is pending. Robert never filed it. He didn't know it existed. 31 days after that notice, with 0 further warning required by law, the IRS issued a notice of levy directly to his bank under Section 6332, and his bank was legally required to freeze and remit funds from his account. Here's the part that guts people every single time they hear it. Under Section 6332, once the bank receives that levy notice, there's a 21-day holding period before the bank must send the money to the IRS. 21 days. That is a legal window to act, negotiate, or reverse the levy. And almost nobody knows it exists. Robert didn't know it existed. He found out about the levy from a letter that arrived the same week the money was already gone, because he never checked his mail with urgency, and by the time he called anyone, that 21-day window had already closed. The total damage on Robert's situation wasn't just the $3,140 taken. It was the overdraft fees on 2 automatic payments that bounced afterward, roughly $210. It was the 6 weeks it took to get partial released funds back for exempt Social Security income, which by law is generally protected up to a certain threshold under the Consumer Credit Protection Act, but only if you formally claim that exemption, which Robert also didn't know how to do. Stack that across a full year of missed retirement account contributions and delayed bill payments, and you are talking about a 5-figure ripple effect from a single unopened envelope. I want to hear from you directly right now. Have you ever gotten a letter from the IRS and set it aside because you were scared to open it? Tell me in the comments below right now, honestly. I read every single comment on this channel. This is not a broadcast, this is a conversation. And your comment might be the exact sentence that gets someone else watching this to open their own mailbox today instead of tomorrow. Now, let's talk about why the system exists the way it does. This isn't a rogue agency acting on its own. The levy authority comes straight from Internal Revenue Code Section 63331, originally codified decades ago and expanded through subsequent collection reform acts, most notably the IRS Restructuring and Reform Act of 1998, which is actually the law that gave taxpayers the collection due process rights we just walked through. But the irony is brutal. The same era of reform that was supposed to protect taxpayers also modernized and streamlined the very machinery that lets the IRS levy accounts with less friction than ever before. The agency has never had to justify the size of this collection stream because it works. Billions of dollars every year come through enforced collections, including levies, and that revenue line has never once seen serious political appetite to slow it down, because nobody in Washington wins votes defending people who owe back taxes, even when those people are 70-year-old retirees who made an honest paperwork mistake on a pension distribution. Let's move into what you actually do about this, because the rules that create this trap are the same rules that let you escape it if you know how to use them. Strategy 1 is what I call the 30-day trigger. The moment you receive a final notice of intent to levy, you file Form 120153 requesting a collection due process hearing within that 30-day window. In Florida, a retiree named Walter used this exact form after a notice of intent to levy over an $8,000 balance, and the filing alone paused collection for 4 months while his hearing was scheduled, giving him time to set up a payment plan instead of losing a lump sum. In Ohio, a couple facing a levy on a joint account filed the same form and successfully argued economic hardship, resulting in the IRS agreeing to currently not collectible status, which halts active collection entirely while their income remains below a certain threshold. In California, a widow used the same form to argue innocent spouse relief under Section 6015 because the debt stemmed entirely from her late husband's business income and the levy against her personal account was reversed. Strategy 2 is the installment agreement filed using Form 9465. This converts a lump sum threat into a predictable monthly payment, and once an agreement is accepted, active levy action generally stops. The math here is stark. Someone who sets up a $200 a month installment agreement on an $11,000 balance keeps full access to their bank account throughout, compared to someone in the identical situation who does nothing and loses a lump sum in a single levy event with no warning. Strategy 3 is the offer in compromise, filed using Form 656, which lets you settle the debt for less than the full amount owed if you can show the IRS that full collection is unlikely given your income and assets. This is not a guaranteed outcome, and the IRS rejects a majority of offers submitted without proper documentation, which is exactly why this step should involve an enrolled agent or tax attorney who knows how to build the financial disclosure package correctly the first time. Strategy 4 is claiming your exemptions immediately if a levy has already landed. Social Security income, certain retirement benefits, and a portion of wages are protected from levy under federal exemption rules, but that protection is not automatic. You have to formally notify the IRS which funds in the account are exempt, using the worksheet included with the levy notice itself, and you generally have very limited time to do it. Strategy 5, and this is the one I want every person watching this to do today, whether or not you currently owe anything, is to set up IRS account monitoring through your own online IRS account at irs.gov, so you see notices the moment they're issued instead of waiting on postal mail that can sit unopened on a counter for a week the way Roberts did. Save this video right now, put it in a folder, call it Family Financial Defense, whatever name means something to you, because when that envelope shows up in your mailbox, you're not going to remember every form number I just gave you. You're going to remember that there was a video that laid it all out, and you're going to come back to this exact moment and follow it step by step. Here's your window. The IRS has been expanding automated notice generation and enforced collection activity heading into 2026, meaning more of these notices are being triggered by algorithms with less individual review than ever before. That means more retirees like Robert, more unopened envelopes, more 21-day windows closing in silence. The trajectory is not slowing down. It is accelerating, and it is becoming more automated every single year, which means the human judgment that used to catch mistakes is being replaced by a system that does not care whether you're 79 years old and living on a fixed income. Like this video right now, subscribe to this channel and hit the bell so you catch the next one before the next trap closes. Comment below with your own situation, because someone else reading it might be the difference between them opening that envelope today or letting it sit for a week. Send this to the one person in your life who still hasn't opened their mail from the IRS, the neighbor, the sibling, the parent. Today, not tomorrow. Save this video to your library so it's there the day you need it. I am the retirement insurgent, and I will see you in the next fight.